Hello and welcome to episode 12 of the Fireplace podcast. Today we're talking about DC pension essentials. So that's defined contribution pensions. Today there's just Mike and myself. And first of all, our disclaimer. This is not intended as financial advice. This is intended as financial education. We are not financial advisors. This isn't regulated advice. We're just kicking ideas around to try and learn together, and hopefully you'll pick up something useful from that. Hello, Mike.
Hi, Andy. Yes, we get a lot of questions about pensions, and we thought we'd have a couple of episodes just covering the basics of how pensions work, first of all, and then another episode to take a walkthrough of how a typical pension works. Pensions are divided into two main types. There are defined benefit pensions, which are slightly more old-fashioned for a lot of people who used to have them, where somebody else looks after your pension for you and pays you out a monthly income once you retire. And then there are defined contribution pensions, which we're talking about today, which is where you or somebody else invests an amount of money, and then when you get to retirement, you then have to sell some of that money regularly to generate an income.
So this is either your workplace pension or a SIPP.
Yes.
That's how you'd be familiar with a DC pension usually.
Yes. So a lot of people will have a pension through their job. And if you're self-employed or a sole trader, then you do that yourself and you get a SIPP, which is a self-invested personal pension. But they all behave in pretty much the same way.
Okay, so today we're going to do just the mechanics of how to do that from the method of using a SIPP. But then in these subsequent episodes, we're gonna tackle a worked example and go into a bit more depth. And then later on in the future, at some point, we're going to focus on defined benefit pensions, which are completely different and outside the scope of this. Yeah,
that's right. Yes, we had a lot of questions about defined benefit pensions, and they tend to vary a lot depending on which one you're in. So what we hope to do at some stage is to get some experts in from maybe the teacher's pension or the one of the big ones like the local government pensions to give us a kind of outline of those. But for now, we'll keep to the easy stuff.
Okay, so the nitty gritty to use a SIPP, basically I need to choose a platform to host it on and open a SIPP account within that. So that might be someone like Free Trade, Interactive Investor, Invest Engine, all of those people, and then select in there that I want a SIPP account. Having done that, it's then a case of choose a fund or an asset to be buying and set up regular monthly contributions.
Yes, and if you do this yourself, obviously you can choose what to invest in, and if you're doing it through your work, they'll probably contact you and ask you what sort of things you want to invest in with usually a smaller set of options.
And then whatever you do with those contributions that go in, a couple of months later, maybe less, you'll get tax credit added. So 25% of whatever you've contributed?
Pretty much, yes. Obviously,
Yeah.
If it's a work pension, then that's all done for you, and it all goes into the pension automatically each month. But if it's a SIPP and you're doing it yourself, then you put in an amount, and then the SIPP platform will add the tax back a couple of months later.
So if I put in £1,000 a month, then at some point £250 is going to magically appear in there because the platform's claimed it back from the taxman. Because this is money earnings that I've already paid tax on. That's the assumption anyway.
Yeah.
Okay. So that's how you set it up, and that just goes along merrily for as long as you wish. And then at some point you decide, oh, okay, I think I'm flush enough to retire now, and you want to access this. So most of us can access this probably at the age of 58 or so, and although it varies depending on your date of birth. So the actual mechanics of getting to it get a bit complicated in places, don't they? So you're allowed a quarter of this pot tax free. So 25% of whatever that pot is, you're allowed to withdraw any time after access age without it being relevant for income tax. Is that right?
That's right. Yes. So the rules changed not that long ago. And before that, you had to buy an annuity with the money in your pension pot, where you handed the money to somebody else and they effectively invested it for you and then paid you a monthly amount. But with the rules changing, you can now do what you want with the money. And if you want to take out the 25% at the start and buy a Lamborghini, you're free to do that.
I suppose the more sensible end is that that's a lump that could pay off your mortgage.
Yes, I mean, there are lots of good things you can do with that money. We discussed this, I think, in other interviews we've had, and we talk about it in the wiki, and it comes up regularly in the group. Some of the things that people suggest are paying off your mortgage is a good one. There's a separate discussion about whether you should pay a mortgage off early. But if you're retiring, a lot of people would say that purely for the hassle factor, it's nice to have the mortgage paid off. So that's one source of it. Another thing people often suggest is it's a good time to give some money to your children. If you've got children who might have junior ISAs, or they might be grown up and might be saving for a house, as long as you can afford to, it's a good time to give them some money, and saves you having to do it later. And that all comes into kind of de-risking, getting yourself ready for your own retirement.
Okay, so we can access this 25% tax-free. The other 75%, the lion's share of this pot, that gets treated as earnings in the year that it's withdrawn. So in the sense of it's just like wages that appear, and your platform will treat this in the same way an employer would, and say, oh, do we need to withdraw tax and hand this over to HMRC on your behalf? So the whole mechanics of that, you if you were withdrawing from this fund, you kind of want to use your tax-free personal allowance each year. So currently that's 12,570 a year, untaxed, and that's free of any income tax. Go ahead.
Yes. So the big difference between pensions and other things like ISAs is that the money you put into the pension hasn't had any income tax assigned to it, and it saved you paying some income tax. And some of the money coming out of the pension is free of tax, but the rest of it is taxed like an income.
So if I go beyond my personal allowance, then anything else I withdraw, that would be taxed at 20% because I'm a basic rate taxpayer.
Yes, that's right.
And that's done at source by the platform, is it?
Yes.
Hopefully. If
not,
if everyone's set up right.
Yes, it's not always 100%. So you need to be a little bit careful, particularly when you start taking money out of the pension, because if you take out a lump of taxable money, the Inland Revenue will assume that you'll be taking that amount out each month, and they'll tax you accordingly until they see a regular set of payments that they can then adjust your tax code. So they're very eager, obviously, to charge you tax. So it can be a little while before your tax calms down and you're paying the correct rate, and you need to be on top of that.
Do they call it the first month tax or something?
Yeah.
So now we get into this array of acronyms, which I'm going to lean on your expertise a bit here, Mike, because I always get stuck with these. So there are three. There's a PCLS, an UFPLS, and a FAD. Now, I'm confident I can tell you a PCLS, pension commencement lump sum, that's that tax-free 25% pot, isn't it, that I can pull chunks of whenever I want?
Yes, it's a bit confusing. So PCLS, or sometimes it's a TFLS, a tax-free lump sum, refers to the actual amount of money that you're getting out of your pension that's tax-free. So you say to your pension company, I'd like some of that tax-free money. And they say, how much do you want? And you say, I'd like this much. And they pay it to you. And that is the PCLS.
Right. So then we've got UFPLS and FAD. So uncrystallised funds, pension lump sum. and flexi-access drawdown.
Yes. So people get very confused about this, and it took me a long while to get my head around it. But they're effectively the same thing. So they're two different mechanisms for getting money out of your pension, and both of them involve getting an amount at 25. Sorry, both of them involve the tax-free element and the taxable element of your pension. The difference between them is in FAD, it's a two-step process where you first ask for that tax-free lump sum, and then later on you ask for the taxable bit. And in UFPLS, it all happens in one go.
And UFPLS is a one-off withdrawal, and FAD is intended to be a monthly thing. Is that the right way around?
Yes, FAD is flexible, as the name suggests. So with FAD, you take out the PCLS first of all, and you get the tax-free money, and then it's up to you. You can just keep on taking out tax-free chunks.
So I could set an instruction with my platform that if I've got 100 grand, we say, right, okay, take the 25 grand tax-free, the 75 grand sits in a drawdown fund, and I can tell my I can instruct my platform, they know that's all taxable. I'd like £1,000 a month paying out to my bank account. Is that about right?
Exactly. Yes. Yes. Most platforms will let you do that. So yes, so you've got your £100,000. You've taken out your 25,000, and you've done something sensible with it, like paid off your mortgage, or I don't know, fixed the roof on your house, or maybe upgraded your car, something like that.
Or I could also be using that for income and spending.
Yes,
alongside this other fund. Yeah.
If you wanted to, if you didn't have anything to spend it on, then there's no point spending it if you have to. So if you wanted to, you could put that in your ISA and leave it invested somewhere and take it out that way. But as soon as you take out that 25%, that £25,000 from your pot, if you're doing the two-stage process, FAD, when you take out the 25,000, at that point, the platform creates a new account for you within your SIPP called the drawdown account, and it moves £75,000 into that drawdown account, which makes it clear to both you and the platform that anything that comes out of the £75,000 pot is going to be taxed.
Okay. So that seems a nice setup. That I am assuming that's more popular then.
Yes. So to go back to your example, you've got your £25,000, which you can do what you like with, and then you tell the platform to take £1,000 out of the drawdown pot each month, and the platform will look at that and go, well, we'll tell HMRC. HMRC will look at it and say, sometimes after a little bit of persuasion, that's less than your personal allowance, so you're not going to pay any tax on that. So you get a nice £1,000 arriving every month in your bank account.
And later on, when that 75 grand drawdown pot is dwindling, I can shunt over some more from my main pension into the drawdown pot and take a corresponding additional chunk of tax-free and top it up that way.
If you're on your £100,000, then the 75 is all you've got. But obviously, if you're starting off,
no, sorry, I was meaning if I hive off 100,000 of my overall pension to do this drawdown function. So, but you can go back again and dip again in the main fund and transfer more.
You can go back and dip again, and you can keep doing that until you either run out of money, or there's the lump sum allowance, which limits the 25% to roughly £250,000.
Okay, but that's for the big hitters, so which isn't me. So when you reach that point where there's no more tax-free allowed, then does everything then go into the drawdown fund?
Yes. What will happen is your tax-free allowance will have run out, and then you've got a choice. You can either take another little tax-free chunk to use up the last amount, or you could sometimes, if you wanted a bit more, you could do an all-in-one transaction, the UFPLS transaction, where you'd get the remains of what's in the tax-free account and then a little bit of taxable money as well.
So far, all of this remains invested in whatever investments you've chosen, and this is just a notional. The platform is just marking this as which pot it's in, because it's still there invested in my chosen index fund or whatever.
Exactly. Now, the plot
Okay.
the platforms vary a bit on how they offer this and to what degree it's automated. So most platforms will pay you a regular amount from the taxable drawdown pot, but some of them will only pay it to you from the cash portion of that pot. So within that pot, you've got your assets, and you may need to sell the assets maybe at the start of the year, or if you want to sell them each month. And then the pot will automatically, at the first of the month or whenever you choose, look how much cash you've got in the drawdown pot, and they'll say, oh, there's more than £1,000 in there. That's fine. We'll take £1,000 out of the cash pot and send it to your bank account and do the same the following month. Some
I see.
platforms, sorry.
Yeah, so you need to manage this. You need to be looking each month. Is there enough in cash that the pay away to my bank will work?
Yes. There are some
Right.
platforms, I know Vanguard's one of them, I think there are others, who will do the whole thing for you. And you can tell them that I'd like to sell £1,000 worth of assets in my drawdown fund, and I'd like you to split it up this way or sell these funds, whatever. And I'd like you to send me the money each month. And they do it all in one go.
And I've noticed that, particularly in the case of some of the otherwise free platforms, the low budget ones, there are some stings in the tail with fees with this stuff. As soon as you want to draw down, you're hit with a 200 odd quid fee or
Yes,
something.
I think what's clear is that the challenger platforms, the free platforms, and the new ones that are coming in tend to concentrate on the people who are accumulating their pensions, and some of them don't really have a very broad offering when it comes to drawdown. And some of them, I think we were discussing this the other week, some of them are only just getting around to offering drawdown options. And because they're new and they've obviously had to extend their platforms, they're charging for them, which might make them less attractive.
Right, so that's the point. If you're at that situation where you're looking at doing the drawdown, you time to evaluate again. Are you on the right platform? Do you want to transfer elsewhere? Would you get a better deal in drawdown? Because the profile of your use has changed.
Yes, I mean for people in the very the free platforms, who are younger, by the time they get to retirement, the free platforms may well have evolved into something with a much better offering and a whole series of drawdown options. But it's always good as you approach retirement to look at what your platform offers and see whether it might be worth moving to a different one that has a better offering.
So rewinding a bit, so I'm quite clear how drawdown worked, FAD. How would UF Plus work differently to that for me?
So UF Plus is in some cases much easier if you don't need a regular income and you're happy to take a chunk out of your pension each year. So, for example, if you think you can live on less than about £16,000, then you can take one UF Plus transaction each year for around £16,000. Now, the UF Plus transaction is doing both parts at the same time. So, of that £16,000, a quarter of it, roughly, will be tax free. So, a quarter of it will come from the tax free pot. And then the other three quarters will be taxable and will be coming from the taxable pot.
So, if to check I've got this right, if I wanted, I could take a 10 grand UF Plus, of which that means 2.5 grand this is a blended from the 25% tax free and the 75% taxable. So 2.5 grand would be tax free, and then 7.5 would be from my taxable pot. And they'd look at that then and consider, have you gone over your personal allowance? Do you need to have tax withheld from that?
Yes.
And when you said you can do 16, is that's not a fixed
No,
limit. That's if you want to remain under the tax wire of your
that's the
personal
maximum you
allowance,
can
I guess.
take. That's the maximum you can take in one UF Plus transaction and not pay any tax.
Right.
I think
Yeah. So this
actually
is
it's
about management of income tax. Yeah.
16,760 because a quarter of that is tax free, and the other three quarters is the same as your tax free personal allowance, the 12,570.
Okay.
So
So somebody could take 100 grand off plus and get 25 grand tax free, but then the sting is that 75 grand counts as income that you've earned that year, and straight away you're into higher rate tax and you're paying quite a chunk on it.
exactly. So that's not a good idea.
Yeah.
So going back to your example, if you wanted £10,000 a year, you could do one transaction and say, I'd like an UF plus transaction, please, for £10,000. And the platform would say, jolly good, £2,500 of that is going to be tax free. The other £7,500 will be coming from your taxable account. So we'll tell the Inland Revenue you've had £7,500 of income, and they'll give you a check. They'll send £10,000 to your bank account. If
Yeah.
if you wanted £10,000 with flexi-access drawdown, you say to your platform, I'd like £2,500, please, as a pension commencement lump sum. They send you the £2,500, and then you can say to them, I'd like the £7,500, please, to be paid out either all at once or over the next year, or I haven't quite decided yet. But you can see that those two different processes are actually doing exactly the same thing.
Yes, the flexi-access drawdown sounds a bit more useful because it gives you the option to leave most of your money invested for a bit longer.
That's right. Now, a lot of people say they do this annually, but the flexi-access, as you say, allows you to do it monthly with a bit more work depending on what platform you're on.
So I can see that the driver for how much to do as a FAD transaction would be what can I do with that tax-free chunk? So I might want to limit it to 20 grand of tax-free so that I can fit that in my ISA. And I might say, well, do me a FAD of 80 grand at a time, and that's 20 tax-free and 60 is going into my drawdown fund.
Exactly. Without going into too much detail, using your ISA can be very tax efficient because what you're doing is you're avoiding paying any tax on money from your pension, which means you're taking less out of the pension, which means the pension pot has a better chance of lasting for your retirement.
So I could do that year on year, and each year do 80 grand of that. So I'm effectively boosting my FAD pot by 60 grand a year, even though I'm drawing 1,000 a month or whatever from it. And so I could do that until all the tax free's used up, and that's all been shunted into my ISA, and I'm just left with this drawdown pot to use in perpetuity.
Yeah, I mean, if you want to, some platforms will also pay you a monthly income from your ISA. So you can end up with a number of different income streams all coming in and all completely tax-free. So I think the other question we had really was to talk about going back to annuities. With the old pension rules, you had to buy an annuity with your pension. With the new rules, you still got the option to buy an annuity. This comes up in our group quite regularly. And the thing about annuities is they don't look very attractive when you're younger, but they get more attractive as you're older. And as we were discussing a bit earlier, I think as you get much older and you've spent your pot on the holidays and things, and maybe when you're not so sharp, they start looking a bit more attractive.
So it's an option that you could, normally an annuity would work with the taxable portion, the 75%
That's
portion.
Right. Yeah.
Because you still can use the tax-free money to do that. You can buy something called a purchased life annuity, but that's quite rare. Everything seems geared up to, oddly, we'll just use the 75% for this.
Yes, and I think that's something that we'll probably discuss in another episode about what happens when you get a bit older and when maybe your spending isn't quite so high and you start to look at ways to safeguard your final years as well.
Okay, so that seems to cover the mechanics of how a DC pension works, a SIPP works. We're going to do another episode following this that does a walkthrough in more detail of how this works. And in the meantime, if people want to read further into all these subjects, they're all there on our wiki and articles anyway that people can access for free and have a read around the subject.
That's right. Yes, we've got descriptions of both UFPLS and FAD. There's a comparison between them, and there's some worked examples on the wiki, and we'll go through it in a bit more detail with what actually happens and the forms involved and things in another episode soon.
Yep, and we've got a link to the wiki in this episode description somewhere, haven't we?
Yes. So at the end of the episode description, there'll be a link to the wiki, and there'll be a link to the Buy Me a Coffee page if anyone wants to chip in and help us out.
Which is proving quite popular at the moment. So
it is indeed.
That's quite gratifying.
Yes.
Super. Well, thanks for that, Mike. I think we've covered it there, haven't we?
I think we have. Thanks, Andy.
Great. Thanks, folks. We'll see you next time. Bye-bye.
Bye-bye.